you so much, Dr. Rabia. We're honored to have you with us today. So we will now kick off the sessions for our summit with our first panel discussion focused on climate finance. We will be discussing investment requirements for achieving decarbonization in the MENA region. So with a focus on the latest practices in the region, such as ESG, carbon markets, and the emergence of carbon as a financial asset, this panel discussion will go into detail about the financing requirements for decarbonization initiatives and the potential that they hold for the environment, people, and the economy. So I would like to call to the stage David Ramos, the Acting Head of Sustainability in the MENA region in HSBC Middle East. He will be moderating the panel. Christian Kunz, Chief Strategy, Innovation and Ventures Officer at the Dubai International Financial Center, the DIFC. Hanam Bakr, Resilience Finance Lead, Climate Change Champions, UNFCCC. Oliver Phillips, the Africa and Middle East Lead, Sustainable Finance and Standard Chartered Bank. Monique Elgen, Senior Legal Counsel of AGGM's Financial Services Regulatory Authority. Gurmeet Kaur, Partner at Pinsent Masons. And Ivano Ianelli, Senior Sustainability Consultant at the Emirates Global Aluminum. We have a pretty big panel, so we hope you enjoy it.
Well, hello everyone. Good morning. How are you today? Good. Let me just get my notes in order. So it's a big panel, and we have 1 hour to go through all of the interesting comments that we're going to hear from a lot of people. I'll skip the introductions because it has already happened, and I think it's more useful if we just jump into the discussion instead of spending a lot of time on it. I will allow you on the first question to have say a few words, maybe 1 to 2 minutes on what are you doing in your organization, and what do you think are the priorities that you're working on these days that could be interesting for the audience. It's just for the first question, then we just jump into it because it's a very busy panel. So the panel has been divided in 3 sections, more or less. The first section is more about setting the decarbonization investment strategies, and there are many reports, but a recent report from BlackRock, relatively recent report from BlackRock, highlighted the investment need to enable the real economy transition and achieve the net zero. It's actually huge. Dr. Nasser said it before. We need 1 trillion per year on emerging markets and developing economies alone, just to put the world back in track to 1.5 by 2050. Of that, 100 million is estimated that would need to come from public bodies, but then it has to be leveraged on from investment from private organizations and other organizations. And on the other side, we have Deloitte's Global Turning Point report that estimated that if we don't do anything about climate change, the cost for the global economy will be around 178 trillion over the last 50 years, with a decrease in GDP of 7.6. So we have 1 trillion per year over 50 years, 50 trillion that we need to address it, and 178 trillion that we will need to pay if we don't do anything. So I think the urgency is in there. Oliver, I'm going to start with you, if you don't mind, as a fellow banker, if we can say that. Obviously, you have a lot of access to companies, through your network, your client, your suppliers as well. What kind of incentives do you think investors need to put capital into sustainable activities, particularly on this region?
Perfect. So to introduce myself very quickly, and I'll stick to your 10 seconds. So I run Standard Chartered sustainable finance business for Africa and the Middle East. So all the kind of ESG financing activities that the bank does in that part of the world. When you're an investor, fundamentally, whether you are looking to deliver impact or you don't care and you just want to keep plowing money into oil and gas, you care about returns. And that is the simple truth of it. Now, a few years ago, there was this sort of constant, how does return versus impact stack up? Can the two go hand in hand together? And the reality is that today it's very, very simple. ESG is just good business sense. So it's really changed the way that you're looking at it from an investment point of view. Whether that's because you're looking at something that you want to invest in the newest green technology and you want to take advantage of that growth, and then it's a good business opportunity, or whether, and I think more fundamentally, there's the risk of not doing things. that could be the risk of just, getting caught out for some governance scandal, and, that's ESG, and that goes back to Enron and the likes. So it's nothing new, and it's not really reinventing the wheel from how investors are looking at this. Or to the more sort of complicated bits at the moment around, climate risk and understanding what happens if sea levels rise and you haven't adapted. Because even if we limit global warming to 1.5 degrees, we're still going to face 1.5 degrees worth of climate change. So there is absolutely no getting away from that. So those risks of not doing things and not adapting are really fundamental. So I think now that's how we've seen it change. Investors are increasingly saying, well, we're going to put money into this. They go hand in hand. Obviously, the kind of the key issue is the challenge of the perpetual quarterly reporting, which basically means you can't look too far advanced in the long run, and is obviously a bit of a challenge. But I think that's something that this region has that inherent advantage around. You have a lot more companies that are not focused on the next quarter. They're focused on the next 10 years, the next 30 years. And that gives them the power to really, adapt. And I think that's why investors are so excited about the Middle East, because you have a great situation where you've got great potential, great green growth potential, and companies that are able to think strategically and act strategically for the long run.
Okay, thank you. Very interesting. And obviously, yeah, I couldn't agree more. Sometimes it feels kind of wrong to say we need to be more sustainable and seen as a commercial opportunity, but it shouldn't be the case, right? I think it's just the only way that is going to actually happen if we kind of bring together commerciality with being more sustainable is when we actually will make changes. Ivano, if I can bring you into the conversation. I want your perspective from a private company that you are from Maurice Global Aluminium on the role of governments. What do you think are the effects that government policies have had in favoring or can have in favoring climate investment choices? How do you see it from the private sector?
There's been, hello? There's been a substantial, number 6? Hello? Here we go. There's been a substantial change recently. For those that remember, in 2012, the EU imposed unilaterally a tax on carbon on all aviation inbound and outbound from the EU countries. This was fought very fiercely. The same is happening nowadays with the carbon border adjustment mechanism, but just because of a piece of legislation that was signed globally, the Paris Agreement notably, this has been having a cascading effect. Now countries are not only looking at the potential of investments in carbon abatement, but they're actually supporting it. So we see new carbon markets being designed, one of which here in the UAE itself. We're looking at regional cooperation on the same, but most relevantly, we start looking at long-term investments from an industry perspective. So for example, if I know that I would have to pay a carbon fee, a carbon liability for my imports in Europe for the next 10, 20, 30 years, that allows me to actually look at the investment value of doing decarbonization today. And how can the government support by creating hydrogen valleys, by creating convergence towards specific technology into the maturity of the technologies itself. And again, in early 2000, solar was just where carbon capture and hydrogen is today. So very expensive, very innovative, yet not commercial grade. So we can expect similar maturity, similar fast track.
So it's all about knowing what's going to happen, right, in the future, or what is the market, knowing the market that you need to play with in terms of regulation policies, and what's going to come down the line, so companies will actually respond and prepare for it, right?
Absolutely. Not only that, it's a cost that we cannot avoid.
Yeah.
So it's we know that it's coming this way, so we might as well embrace it and try to leverage it as an early adopter, vis-a-vis just writing a check to the EU, which would favor my country, but would not my employer.
Okay. Good. Hanan, if I can go to you. You used to work with us. You used to be a corporate banker.
Yeah, I quit the bad people with the good people now.
You decided to go and try to save the world, right? Obviously you've been exposed to that corporate banking area or sector, and then now you're looking at things from more of a multilateral development organization. How do you think that corporate and investors identify the right components to create decarbonization strategies that are actually tackling not only their own operations, but three scopes of like all the supply chain, value chain, and the three scopes of emissions?
Sure, I'll give you the recipe later on, but I would like to start as well that we usually talk about climate change from the dark side of it and how we incorporate the physical climate risk and risk management, and we miss out on the opportunity for businesses to be investing in renewables and decarbonization and the energy transition pathway. So let me share with you some numbers as well, so I sound more credible to you and convincing. So usually when we think about energy transition, there are four components that we think about in business: cost, energy security, environment, and loss of jobs. So first, about cost, it's proven that the cost for renewable energy has drastically becoming less over the last 10 years by like 60 to 90%. Energy security, 90% of the people in the world are already living in countries that are abundant in energy. And most of the demand of energy in the world comes from China and India, who are increasingly being reliant as well on fossil fuel. Environmental perspective, it's out of the question that renewables are, the ecological footprint is 100 times less than the fossil fuel. When it comes to loss of jobs, the IEA has already calculated that there are a lot of jobs in the clean energy industry, much more than fossil fuel. Actually, the energy transition might gain 22 million jobs as a net gain of new jobs. So it's for the private sector, who's most probably leading the way on the climate tech and the energy transition, the mindset has to be really to thrive and not just to strive. It's good to be including risk management, to think on the defensive way, but you need to be as well on the offensive way and to capture the growth opportunity from the climate crisis. And back to the recipe, since we have to wrap up on the recipe. So it's really three things to think about if you haven't already started thinking about energy transition or decarbonization. First, you need to set short-term and long-term realistic plans, including just transition. So when we look at the ESG, we don't want to be resolving for the E and creating another problem on the S side by loss of jobs, or that we're not balancing out the energy transition from decarbonization or upgrading the employees particularly, and forgetting as well about the inclusivity and the gender equality. Secondly, we need to think about the monitoring and the reporting and the disclosures and the transparency, particularly to avoid greenwashing, which is a very hot topic now. It's not about investing or showing to the world that we're good and we're doing green transition. It has to be impactful with co-benefits, and it has to be real investments in green or climate change investments. Secondly, the benchmark. So what would be the benchmark for a company starting to think about energy transition? One way would be the country NDCs. If you're operating in a country that doesn't or did not pledge NDCs and you're more aspirational than the country, then you have, for example, the Race to Zero campaign or any accountable or credible SBTs in the industry.
Seems like an easier recipe to implement, no? I don't know why are we not doing it. No, very interesting. Thank you for all of that information. I almost need that. We needed a slide for all of those numbers to remember them. But thank you. Just a little bit. you can start thinking of questions. We are aiming to have a little bit of time for Q&A at the end of the session. So please start writing down your questions, and we will have hopefully 15 minutes for that. So don't sleep too deeply. Just continue listening to us and take note of those. Monique, I want to bring you now in terms of one of the multiple regulators that we have in the UAE, in the region. What do you think that's the role of regulations in kind of directing the flow of those, the flow of capital towards sustainable investments, particularly in this kind of global economic situation that we have now? And just a reminder, if you want to say a few words about what you do in ADGM, I think many of you didn't take that opportunity.
Perfect. I don't want to capitalize too much on everything that everybody has said already, but the reality is the role of the regulator is intrinsically linked to all of the things that my co-panelists have mentioned before. And indeed, Dr. Rabia, I think she gave us a bit of a chastening overview of the amount of effort that needs to go into not just the flow of capital into the transition, but other aspects as well. And I think probably there is a role for the regulator and regulators globally in supporting the need for harmonisation and supporting some of those geopolitical evolutions that need to take place. So at the FSRA, at ADGM, we take our role as a regulator in the climate transition and the energy transition extremely seriously. We're committed to it. We talk about it a lot. We've made it one of our prime areas of focus. There is a gap when it comes to funding the transition, spanning trillions and trillions of dollars. And the only way to resolve that is by bringing funding into transition projects that will enable the transition to net zero. Ultimately, finance is about trust, and sustainable finance, therefore, of course, is about trust. And there seems to be, as Oliver said, there is real investor impetus towards the green transition right now. No question about that. And we can lose that impetus by permitting greenwashing, by failing to be clear about acceptable standards, by not creating integrity in the markets when it comes to this space, and thereby reducing the flow of capital, which in turn starves the transition of what it needs to bring us all to net zero ultimately. So if that's why the regulator has a role in this space, how can we support as regulators this very, very important, critical, necessary evolution? Well, we can set clear, credible standards and frameworks as soon as possible. We can take feedback from our stakeholders on them and increase or expand or develop them, and we can make sure that they are appropriately commercial, so that these are not just pie-in-the-sky ideas, but real initiatives. We can identify proper standards against which green initiatives can be measured, or support the identification of those standards by setting out parameters for industry to do so, and start the discussion about how to verify or attest adherence to those standards. We can start the journey, if the journey has not already started, in terms of requiring all entities to start thinking about how they disclose their performance against ESG metrics, not just the E, as you said, Hanan, but the S and the G as well, to ensure an equitable transition. And we can make sure that we are continuing the dialogue, cooperation, bringing investors, bringing industry, bringing stakeholders, international and local authorities together to ensure that this is a meaningful, inclusive transition. So in the ADGM space, what have we done? We have, for example, amended our markets framework to require ESG disclosure. We have amended our framework to facilitate regulation of offsets, carbon offsets, as a financial instrument. And we have recently closed the consultation period on our sustainable finance framework, which is, we hope, going to be one of the most comprehensive in the region. The feedback has been fascinating, and I don't think it's inappropriate for me to say the feedback has, to a large extent, been more regulation, more regulator involvement. We want integrity, we want trust in these markets. The game is getting too close to lose.
It's very interesting what you're saying in terms of a lot of things that regulators can do. and I will put you on the spot a little bit. Is it really happening overall, not specifically ADGM, but do you think that the way, maybe not only on the region, but globally from your experience, is that the industry is leading and then regulations come later, or do you think regulators come before and then the industry leads?
That's great. That's a great question. I think it's quite symbiotic at the moment. So there's you get this driver of investor demand. People want it, and so industry will create it, and then regulators need to fill the gap to ensure that that trust and integrity remains. Equally, by creating platforms and frameworks that facilitate the development of those opportunities, they tend to grow because the investor confidence will be there. There is a supporting element. So it ebbs and flows depending on which region you're in, what industry you're talking about, and the various parties involved. But I think that symbiotic evolution, as Dr. Rabia said, is very important. We have to do it together, not one first and then the other. We evolve and we develop, we listen to each other, and we grow.
I think we all want a lot of regulation until we actually need to implement it, right? And then sometimes we struggle with being fast enough in the industry. Good, thank you for that. Gurmeet, you work in a law firm, so probably you have, probably not for sure, you have a lot of experience on conversations that you're having with clients, multiple corporates. So how do you see, we've talked a little bit about government policies, Ivana mentioned regulations and all of that, but how do you see the actual implementation of those government policies and regulations on contractual frameworks that are actually helping promote or driving those flows of sustainable finance strategies?
Thank you very much, David. Can everyone hear me? Yeah, great. So, as David said, I work in a law firm. I work in a company called Pinson Masons. We are a global law firm, and we specialize in energy and infrastructure projects. And my specialty is really energy, and within energy, in particular, renewable energy. So certainly this question and this topic that we're discussing here is very dear to me. So firstly, on government regulations, I agree with what Ivano and Monica has said. You know, governments have a big role to play, certainly in terms of shifting behaviors and getting, you know, investment into the right markets. And when I first came to the UAE 15 years ago, solar was pretty much unheard of. And then, you know, in the last 7 years, we've seen how much that's changed. And it's largely to do with the commitment of governments, but also they've then set around, you know, some changes in the regulatory framework so that, you know, it created some level of certainty in order to encourage investments. And I think regulations have two different ways in which they can do that. Obviously, it can be a carrot in, for example, what we're seeing in the US with what Biden is doing in terms of the Inflation Reduction Act, you know, providing more subsidies for investment into this area. We're also seeing regulations act as a stick, as Ivano said, you know, carbon tax and things like that. But we've also got regulations which support, you know, the surrounding industries, just general legislation that would help in terms of easing business and how you do business. So certainly in the UAE, we've seen changes in the company law, making, you know, registering businesses a lot easier. We've seen, of course, removal of some of the subsidies as well in terms of fossil fuel, and this has encouraged, you know, the uptake of clean products such as electric vehicles. So these are sort of broadly some of the changes we've seen in the region. And how has some of these changes impacted the contracting structures? So I'll talk about three different areas that I've, you know, personally been working in. So one is in terms of rooftop solar and distributed solar. You would remember that in 2014, the Dubai government introduced regulations to enable rooftop solar to be connected to the distribution grids. And as a result of that, that kind of kickstarted that market. But one of the challenges that we faced was that there was also competing regulations which said pretty much DEWA was the only authority that could sell power. So, you know, in order to create this market, we had to come up with creative contractual solutions on how to get around that. And the model that was developed over time was to use solar leasing contracts. So essentially what this does is that the developer would bring in the finance, they would install the kit, they would operate the system, and in return, you get paid over a period of time. But it was a form of leasing of the equipment to the customer, and in return, you get paid based on net generation of the power. So this was a new form of contracting structure that came about in response to government policy, and it overcame some of the hurdles. Another example is obviously in the energy efficiency schemes. So in 2010, the Dubai Integrated Energy Strategy was announced by the Dubai Supreme Council of Energy, and the government also introduced a number of green building regulations and codes, and had an aim of wanting to retrofit about 30,000 buildings. And essentially, DIVA had established a subsidiary called Etihad Energy, which was then sort of had the role of trying to kickstart that market, where they facilitated funding and packaging the products. So you had EPC and O&M contractors coming in to implement the projects. And as part of ensuring that policy was supported, the Regulation and Supervisory Bureau of Dubai and Etihad Energy as well developed model energy saving contracts. So these were contracts where essentially the ESCO would guarantee a certain amount of energy savings, and in return for that, they would get paid a certain amount of monthly payments over the period of the project. So that's another example. And the third one was in relation to hydrogen, actually. And this is very interesting because I think one of the key tipping points, if you like, that's going to accelerate energy transition in the years to come is this move towards hydrogen. And we have seen, although there's at the moment no regulation specifically on production and storing of hydrogen, etc., in the region, Abu Dhabi is certainly developing those regulations, and there's been a lot of announcements made by government in terms of their hydrogen roadmap. Certainly UAE announced that in COP26. And as you get more and more hydrogen projects coming up in this part of the world, what I expect to see as well is changes in the contractual structures to respond to that. And the traditional model in the MENA region is you have a single point of responsibility, a traditional form of a power purchase agreement, which has been tried and trusted in the region for a very long time, but it does push down all risk, it pushes down all responsibilities to either the EPC contractor or the O&M contractor. And in my view, that's not necessarily the best model, especially when you're talking about hydrogen projects. And why is this? It's because hydrogen projects are multifaceted projects. So you've got various components, for example, the solar bit, the electrolyzers, the other interfaces, battery, storage components, etc. And so to put all responsibility on one contractor would mean that the EPC contractor would build in various contingencies in its pricing. It will obviously have to reach out to specialist subcontractors to do the particular pieces of the puzzle in terms of a hydrogen project. And these subcontractors as well would add on contingencies to their price. So ultimately, developers would not get the best and most competitive pricing, and we can lower the price if you move to a contracting structure where the EPC does not have to price in risk that it doesn't understand. And what we're seeing in other jurisdictions, such as Australia, for example, where we have a lot of clients who are doing hydrogen projects, is a move towards different contracting structures where you break it down into different packages. And so you move away from just the one single point of responsibility. And this is something that happened in the wind industry as well a number of years ago, where there were packages of contracts and lenders ultimately got comfortable. One of the other areas for hydrogen is obviously the rapidly evolving technology. So the contracts as well would need to deal with this. So to build in mechanism where you can get technology updates as you move through the term of the contract. And finally, I just wanted to introduce the concept of collaborating contracting as well. So this is another structure that we've seen in other jurisdictions globally. So as I mentioned, Australia and the UK. And what happens here is that the parties, and it's a little bit of what Monique said, everybody needs to come together in order to make this thing work. So it's the same thing here when you talk about collaborative contracting, but we sort of enshrine that in the contract itself. So basically, it starts off with a traditional EPC, but it has a more sensible allocation of risk and more reasonable extension of time process and things like that. Collaboration is encouraged at all levels, so you often have a steering committee where different project parties are involved, and the different project parties, they commit to the goals of the project and the commitments that they collectively seek to achieve. You also have remuneration that's linked to KPIs. So basically, people are incentivized to do what's best for the project rather than just for the individual companies. And then finally, you also have a more rapid kind of dispute resolution forum. So because of more dialogue, because of more collaboration, disputes can sort of be identified early, and it can be addressed a lot sooner. You don't have to wait, till there's a big dispute and, head towards arbitration. So those are some of my thoughts on, how you would end up seeing different contracting structures as you respond to this new sort of shift towards clean energy projects.
So it seems we have all the solutions, but why is it not happening? What is preventing the industry to adopt those new type of contractual relationships or structures that are going to help at the end lower the price or expand implementation? I was wondering if why don't we have all the buildings in Dubai covered by solar panels? You mentioned at the beginning solar was unheard of. It made me laugh. We are in the region of solar. Or why are we not refurbishing all the buildings? Because it seems that the money is there. There are ESCO companies that are doing that. So what is it missing?
Yeah, so I think just in terms of why we're not seeing it yet here, I think we are seeing it in, generally, globally, and in terms of this region, certainly for hydrogen projects, it's still quite new. So we haven't really seen the kind of, developments in hydrogen and some of this newer technology yet happen here. It will come, as Ivana also said, and we'd seen, the progress within solar happen over a period of time as well. In terms of the uptake for rooftop and energy efficiency, I think one of the challenges is obviously, consumers residentials haven't really taken that up in a big way, largely because of the low price of electricity. So until, the pricing is adjusted, you probably won't get that huge uptake that you would like to see and which you see in the, parts of Europe, etc. We have seen the uptake largely in the commercial and industrial sectors because obviously the price of electricity there is a lot higher. So there's, obviously a lot more work to be done, but, it is steps in the right direction.
So hands up who wants the DIWA bill raised or doubled in the next few months, please, so we can advance on this. Nobody? Okay. We'll get there. So I want to take, I haven't forgotten about you. I know I'm good at taking the microphone, but I want to go to the next section, otherwise we're going to end up without time. I wanted to talk a little bit on this section about carbon markets. Obviously, everybody heard about the famous Article 6 of the Paris Agreement, and that allows countries to actually voluntarily trade emission or help the emission reduction targets through trading mechanisms for achieving the NDCs. 83 of the global NDCs available right now, or publicly communicated right now, include, 83% of the ones available now, they include these market mechanisms as a way to being achieved. And the global voluntary carbon market was valued at 2 billion in 2021 and is expected to reach 17 billion by 2027. So Christian, finally, and you have as well your opportunity to tell a little bit more about what you do. How do you think all of this activity and all of that that's happening around carbon markets, how do you think governments in the region can enable smooth implementation of those voluntary carbon markets? What do we need to do?
Great, yeah, thanks. Great to be in this panel. I'm glad to see a full house. I think it's an important conference and very good discussions. So I lead strategy and innovation for the DIFC. I'm also the chair of the Dubai Sustainable Finance Working Group, so with many of you being members of that. And I think we are in a very unique position because I work a lot both with government, with regulators, with ministries, but also with the private sector. Both with international organizations like yourselves, as well as with startups that are just having one person. And so I see a lot of the challenges and the opportunities in this space. And I think this is where obviously our role as a semi-government entity and as kind of an influencer working with many of the different organizations comes into place. We'll talk a bit about carbon markets, but this holds true for the whole ESG agenda, I would say, on the broader scale. Two things we heard this morning in the opening presentation, which I found very interesting, but also very kind of bringing it to the point. On one side, we see all of the developments, I would say, arguably most of the developments in ESG and in green energy growing fast, but not fast enough. It needs to go even faster. At the same time, and that holds true for globally as well as for this region. At the same time, the gap is widening between countries and between organizations. So we have some countries, mostly the developed countries, as well as international big organizations that are leading the way, and we have a big tail of companies and individuals that are not able to follow at the same pace. And I think this is quite an interesting problem to solve. And it's a very difficult one to solve at the same time. So what role do we play in this context as DIFC and as kind of government institutions? One obviously is driving awareness and education. I think the working group is doing a lot of this. Everybody's trying to do it, but it's very important that all of us understand this. And in carbon markets, it becomes even more important to understand how it works, why it's important, how to use it as a transition tool, especially voluntary and then in the future potentially compliance markets. How do you vet and understand if those credits really are the right ones? And there's lots of discussions around that. How do you create kind of that awareness, where to look and how to look for that? When to use it, how to use it, and avoid using it in the wrong way. But also having continuous awareness discussion around how can we improve the certification and all the research and science behind it to make that more robust. So one is education, awareness, and I think that's one of the biggest tasks really to drive forward. The second is infrastructure, really building the infrastructure. And in carbon markets, that includes having a registry in place, making sure that those are properly registered. We avoid double counting. We ensure that it's not small, markets developing by itself with lots of questions behind it, but rather like, building infrastructure around making this a scalable and a trusted ecosystem, and that's kind of a larger government effort. And I'm glad to see that things are progressing very fast in that space. So there's different types of infrastructure that also includes regulation, also includes which regulation, which frameworks to follow, and I hope we're not going to invent new ones, but rather build on the existing ones that are globally kind of merging to be a few that are adopted by most, because I think globally we have over 1,100 frameworks and standards, so I hope that we can rather condense them to enable and also cross-border, much easier cross-border transparency and exchange. And the third one is building markets, and I think, again, many of my speakers before talked about that. We want to enable the private sector to create the market in collaboration with the government. And I think creating markets means creating the dynamics for it and then letting the private sector, the supply and the demand, kind of manage that, but with the frameworks and infrastructure and the awareness and education that I described. So I think that's sort of the way we look at it, and we'll talk I think, a little bit later about the working group as well and how we jointly can work on driving a lot of those things forward.
Yeah, so a lot of things that need to happen, right? I think a lot of questions to be answered, and maybe Oliver has answers to some of those questions because Standard Chartered has done a lot of work in carbon markets, in voluntary carbon markets in other regions. So how do you think we can achieve that high quality and high integrity activities under carbon markets? What's your experience for what you've seen happening otherwise?
Well, I wish I had all the answers. That would make life a lot easier. But I think one of the really encouraging things with the carbon market is that the private sector took back control. Now, Article 6 has been around for a while, and governments have unsurprisingly gone round and round in circles as everybody tries to get their own agenda across, as happens for almost every single high-level negotiation for anything. So in 2020, I think, if I'm getting my years correct, it all blurs into one at the moment, the private sector basically said, no, enough is enough. And we formed the Task Force on Scaling Voluntary Carbon Markets, which brought together actually a number of people on this panel. I know Ivana was part of it, for example, and so was Standard Chartered, and I'm pretty sure HSBC was involved at some point as well, and said, okay, in the absence of a proper framework around Article 6, let's create standards ourselves. Let's define what is a high integrity carbon credit. What attributes need to be met so that when I, as a corporate or as a trader or as anything else, or even a regulator, look at this, I can see what are the different things that need to be there so that I can be sure that the carbon reductions are real, that they're permanent, that the carbon credit has been additional. It's not just making profit for the sake of making profit. It's actually allowed something to get financed that wouldn't have been financed before, and a host of other things that we called the core carbon principles. And then building on that, we saw two things that emerged after that. The Integrity Council on Voluntary Carbon Markets, which directly stemmed from the TSVCM, and that's really focused on the demand side, the supply side. What are the right things, and how do we create carbon credits that you can actually be confident in? And then we also saw something called the Voluntary Carbon Markets Initiative, or the VCMI. That's confusing, I know, ICVCM and VCMI, don't ask. But basically that came out on the demand side. So saying, okay, what is how should you as a corporate be using carbon credits and carbon offsetting as part of your net zero and your transition agenda? And really making sure that the two marry up so that you're driving corporates to go and get the best quality credits, but you're also making sure that there's a supply of credits that you could be confident in. And what I think has been really great to see is the private sector has continued to do this. And even in the wake of some lovely articles in the UK press over the last couple of weeks about avoided deforestation credits under the UN's RED, that's REDD, plus framework, that actually a lot of people have come out and say, okay, fine, not everything's perfect, but not everything has to be perfect. And something my old boss used to say is, don't let perfect be the enemy of good. Now, that's not saying we need to go and forget about standard and forget about quality and integrity, but there needs to be a little bit of compromise, because at the moment there is just not enough money flowing into the right things. And carbon credits and carbon finance is probably one of the single greatest tools we have to change that. Another green bond is another green bond, but the bond market is already there. And yes, we can green the bond market, but it's an existing pool of capital. We need new pools of capital if we're really going to deliver on the amount of financing needed. 95 trillion by 2060 is one of the numbers that we came out with last year, just for emerging markets to get to net zero. And again, that's 10 years too late, because that's 2060, not 2050. So the scale is still pretty enormous. So I think it's really going to be something that we need everybody working together. We need regulators to be driving the right standards, but not trying to reinvent the wheel. Building on the things that the private sector has already said, this is the direction we want to go in. And then we need to see things saying, okay, right, if, for example, ADGM, if you are listing a carbon credit vehicle in ADGM, then should you be following the core carbon principles, for example, and should you be reporting on that and disclosing on it? And 2 weeks ago now we had a conversation about there's data and there's good quality data. The private sector, I think we need to hold ourselves to account. Those of us that are in the middle as financial institutions need to be making sure that we're driving quality and integrity on both sides. Project developers, they should be going for the best quality, because we're seeing a divergence in the market. Not every ton of carbon is equal. You get different qualities and you get a higher price for a better quality, as it should be. And then for buyers as well, it's very easy as a buyer to go and say, okay, well, I need to offset, so I'm going to buy the cheapest credit out there, because why would I do anything else? But actually trying to look into the long run a little bit, thinking about the reputational risk associated with some of those less quality credits, and thinking, okay, I want to make a credible claim. Perhaps the next thing for EGA, you've done solar aluminium. Perhaps the next one is offsetted aluminium. Is a BMW going to pay top dollar for something that's wishy-washy offset, or will actually be able to drive a higher price by going for something that's higher quality? So I think it's really about everyone continuing to work together and making sure that focus on quality and integrity is front and foremost.
Great, thanks. And now is the difficult time where the role of the moderator becomes annoying, because I need to ask you to keep the answers a bit shorter. We are running almost out of time, and I promised some time for questions. Hanan, very briefly, what do you think are the environmental, economic, and social impacts that creating a robust voluntary carbon market in this region can bring?
Sure. So quickly, the carbon market is really the newest hot commodity. So we call it the new oil. And why is that? Is that the reason is that carbon market has the capability to advance equitable climate action globally. And let me give you a quick example of one of the projects from the global south in Africa, and then that will answer a lot of questions and why carbon market has the capability to be touching on mitigation, adaptation, resilience, and biodiversity as well. So Ghana, for example, in Africa, and we know that Africa, they are already negative in their emissions. However, they are requested as well by the global community in order to add their own NDCs. And part of their NDCs program is that they are soon, they are going to be launching an agriculture climate smart program whereby UNDP are supporting them. And this is going to be funded through voluntary carbon contribution with Switzerland. And this will dictate that there will be more than 10,000 rice farmers that are going to be trained for this new climate tech smart technology. This will reduce drastically the methane emissions from agriculture. It will cut their cost in terms of pumping water, and it will be achieving their water efficiency usage. So look at these simple projects of carbon project development and how it has created already a business corridor, trading corridor between Africa or Ghana and Switzerland. Think of this scale between Middle East and Africa. Africa has a huge potential. I'm a big fan, and at COP27, which was an African COP, we have seen the African business case in terms of mitigation, resilience, and adaptation, and the huge potentiality. And carbon market, particularly in the Middle East, it's evolving. And this is to the point of Monique that has mentioned earlier. Are we creating the regulations and policies, or the business case is being created first? And I think carbon market is one of the cases whereby the market has been already created, and the governments and regulators are catching up in order to regulate this huge trade activity and potentiality. Look at Jordan. Jordan now is the first country from the developing countries to be launching their MRVs, and the system is going to be replicated in Gaza and West Bank. PIF and Tadawul has launched last year the Riyadh voluntary market. Egyptian Stock Exchange, they have as well announced at COP27 that they are going to be launching their Africa voluntary platform, whereby they will give an access to African countries who doesn't have their own stock market to be trading that. Huge potential to trade business case and trading corridors between countries. And I think for the region over here, the Middle East, when they think about carbon market, Africa should be included in the case because there is a miss out on the African countries in terms of investment for climate-related projects. And it has a lot of co-benefits as well, so it's a win-win situation when it comes to carbon market.
Very true. Ivano, you've been very exposed to carbon markets and in your previous life. Do you agree with Hanan? Do you see a potential of outside of the GCC countries leveraging on the rest of the region for that?
By all means, and I have to actually give a little bit more context because what she said was spot on. So take EGA. EGA is the world's largest premium aluminium producer. So with aluminium, it's an infinitively recyclable material. So it's fit for purpose for our decarbonization efforts globally. However, there are some emissions which are existential. With current technology, we cannot remove them. And this is where Article 6, which hopefully will be finalized at COP28 later this year, will play also a pivotal role merging these voluntary carbon markets and country national inventories. So if you take all these registries that are there, whether it's for solar power, whether it's for carbon markets, the importance is assigning those units to a specific activity, entity, country, and doing this transparently. EGA is looking at options to decarbonize, not just offset. So just like Switzerland, we'll be looking at partnerships with jurisdictional programs, with other initiatives, both local and regional, to decarbonize and transfer through the finalization of Article 6.2 or the new carbon market under 6.4, this credit back into the national inventory of the UAE. And this is how this model will actually facilitate also the investment opportunity. What was at the beginning of the golden age of carbon markets, harvesting the potential of private sector, specifically into decarbonization.
Yeah, totally agree. I see the clock, the big clock that you guys don't see, but I see it running very fast here. So Monique and Christian, both of you, I'm going to bring you together and I'm going to have you for an elevator pitch, 30 seconds each. How are you driving your efforts from your own respective organizations around promoting adoption of ESG and helping companies to kind of also report more and being more transparent around ESG policies? I'll start with Monique, if you don't mind.
Thanks, David. It's going to sound like Oliver and I coordinated our responses, and we didn't, but maybe that's a good thing. The time for words is over, the time for action is here. ADGM feel very strongly about that. We have used offsets to become the world's first carbon neutral international financial centre. We think that's important. Emissions reductions are critical, but offsets are an important first step. We have amended our regulatory framework to enable the establishment of the world's first regulated voluntary carbon trading house and clearinghouse, carbon trading exchange and clearinghouse, which we think is critical. It's being established in ADGM by eCarbon. We hold a number of events every year, and events sound like just talk, but they have shifted recently. Abu Dhabi Finance Week got enormously good coverage internationally due to the investment there. A whole day of that was dedicated to sustainability. The world's leading investors, the decision makers from those investors, met entities who are driving the transition to net zero at that event. There are other things I could talk about, but I'll hand over to Christian.
Great. I'll talk about 2-3 things. One is the Dubai Sustainable Finance Working Group, which we established with DFM jointly in 2019. This is really a working group that differentiates to many others in being kind of where the translator of ambitions and the policies globally and that come in place here to translate into real education, awareness, and useful tools for the industry by kind of private and public sector entities working together. So we're over 30 members, very active. Obviously yourself, Oliver, are part of that group. We have 7 sub-working groups now. We publish reports around sustainable investing, sustainable issuing. But I think the last tool we published was an ESG self-assessment, ESG maturity self-assessment tool. jointly with the UN. We launched it last year. You can download it from our website as well. This tool I find very important because it's free, it's simple to use, and it enables kind of the larger community of SMEs and individuals that are wanting to get into this space very simply without having to spend a lot of money, and to start measuring where they stand for themselves. There's no risk, and then start the conversation internally or otherwise. On the other side, obviously, DFC has been driving sustainable finance for a long time. Nasdaq Dubai, for example, is the largest exchange globally for green sukuk. So over 60% of all global listed green sukuk is listed on Nasdaq Dubai. Similarly, the green and sustainable sukuks and bonds are growing very fast and are the largest in the region. We also work a lot on the venture capital side. I think there was a report that the Clean Energy Business Council also issued on VC for climate specifically, but we work a lot on ESG innovation. Where does it stand at the moment? Where are we as UAE and as Dubai, and what needs to happen in terms of that? So we're going to publish more reports on that in March as well. And then obviously we have DFC Academy, so there's a lot of courses to educate. I think one of the biggest challenges, like we have on one side technology talent challenge, I think we have an even bigger challenge on sustainable ESG qualified talent in the region and globally, and also getting a baseline for everybody, especially decision makers, especially from the board downwards. I think the boards have become much more active and aware and educated on it, but now the next C-level and the managing levels below need to get really educated on that space, and that's a big priority for us as well. Thank you for that. In the spirit of fairness, I want to give Gurmeet an opportunity for a second intervention as well. We talked a lot about how companies can kind of implement their own ESG strategies and policies internal. But how do you see, from a legal perspective, which I think is important, how do you see the legal considerations of implementing ESG measures when you have a complex supply chain and a lot of stakeholders involved? How can we sort it out?
Yes, thank you very much for that question. I think we've heard from all the speakers that, you know, it makes absolute business sense for companies to implement ESG measures. You know, there's various reasons that drive that, which I won't labor on given the time. But so it's not a question of why anymore, but it's more a question of how. And so companies need to think about, you know, where they can make the most impact in terms of reducing, for example, carbon emissions. And one aspect where they will need to consider is really how to reduce it in the supply chain as well. And this is where a number of our clients have come to us for some advice, because obviously it does mean rethinking some of the supply chain arrangements. How do you incentivize your supply chain to also go along with you on this path? And we have done a number of things in supporting our clients. Some examples of this including you know, in their tenders, for example, ensuring that all tenders that that particular company issues out to suppliers would favor a low carbon solution. So tender evaluation criteria will get shifted to sort of favor low carbon solutions. We found that also companies need to communicate very clearly and transparently with their supply chain. So you do this through education, so workshop, literature, dialogue with the supply chain itself. Another aspect which has worked well is for the companies to form a sort of steering committee with key members of the supply chain, where again there is this dialogue and discussion on how they can continuously reduce carbon emissions. And another thing we've done in terms of the contractual arrangements is actually to build in incentive structures. So what I talked about before was, you know, a KPI regime, that kind of a structure where you incentivize your supply chain to make lower carbon choices. And I think, you know, it just all goes down to embedding this low carbon thinking throughout your interactions with your supply chain and making sure that they are on board the same journey with you. Just very briefly also, a lot more due diligence is required because obviously, when companies commit to these targets, the last thing you want is to be tripped up, because there's been human rights transgressions and things like that in your supply chain. So I think we're going to see companies do a lot more due diligence as well. And this may lead to some, difficult decisions. For example, you're having to change your supply chain because, you can't get satisfactory due diligence status. And we've had real examples of our clients, who face these challenges. So ultimately, I think there are trade-offs because obviously in the short term, you've got more reporting, you've got more dialogue, you've got more, basically investment in clean tech as well to make sure you can have carbon reduction. But in the long term, it'll be all worth it because I think ultimately we will get to a point where everyone would understand that both purpose and profit needs to go hand in hand.
Great, thank you for that. And we've nailed it with 45 seconds left for questions. The good news is that we have the coffee break right after, so I'm going to offer my panel, don't kill me for that, maybe 5 minutes of that coffee break, we can take it for questions, if there are any questions in the room. Any hands up? No. There's one question over there at the back. Is anybody handling mics? The lady in red at the back.
Hello. Hello, my name is Iman Ben Hayyan, I'm from Aqua Power. I just have one question for Ms. Gurmeet. You have been discussing other ways of structuring an EPC contract in a hydrogen project that would be a bit structured like an IPP project. I just wanted to understand, how do you think this could be financed, especially that you have been talking about contingencies and buffers that EPCs and their subcontractors usually consider in their quotations. Don't you think that would be offset or maybe counterbalanced by the expensive prices of financing, cost of financing, coming from that risky project that would be triggered by having actually several subcontracts under the project companies instead of one EPC contractor taking all the risk?
Yeah, thank you very much for that question. I do agree, it's a lot more challenging, so it's not as simple, and that's why there needs to be a lot more education, because financiers as well has to come on board that journey. But we've certainly seen that happen in other industries, like in the wind sector. So, when we talk about wind projects, it's not always the case that you have a single point of responsibility in the form of the EPC contractor taking on all risks, but you do have, the turbine supply manufacturer who would engage directly, and then also the balance of plant supplier who would engage directly. And these risks are understood and accepted. So I think eventually we can get to a position where lenders do get comfortable as well with the structures, because it's all about managing the interface risk, and if the developer can show how they can manage that, then ultimately that risk can be mitigated, and you can get a better overall product. We're certainly not there yet here in the Middle East, and the traditional thinking is always use the same IPP model and push down all risk to the EPC contracts. So I'm not saying it's going to be an easy journey, but I'm just saying that there are alternatives out there.
Okay, just one other clarification. When you say wind projects, OEMs usually can be separated, and this is what we had also in the NEOM Green Hydrogen project that some people in the room might have heard of. But are we also considering, or are you also considering subcontractors within the BOP scope? Because I think that's a bigger risk that comes also with the fact that there's an interface between several contractors, and that interface is basically the main point of risk that the EPC handles alone. If we open that, I think that interface risk comes back to the project company. And from my personal experience with the NEOM Green Hydrogen project that we tried to structure this way, this was not accepted by the lenders. So as you said, this is for now absolutely not expected from the lenders and banks, but hopefully will come back around in the future. Thank you.
Yes, thank you very much. I mean, I do agree with your comments, and certainly the intention is not to manage all the, subcontract arrangements, but I'm talking about the main, components of the project, because you do have different technologies, the solar side, the electrolyzer side, and in relation to those main components, you can have direct contracts, but obviously those contractors then have to manage all their various subcontracting chains.
I think this is a very interesting conversation to have over coffee, the two of you. Can we take one more question if there is? Are you guys all right with that? Yeah, nobody's. Anybody else? Any other question? Here, do you have? Yeah. So I'll do the introduction. He's Jonathan from HSBC.
Hi, thank you. Maybe one for Oliver. What are banks doing, or what do they need to do to sort of adjust their credit or their risk appetite to finance more sort of the new economy or the big infrastructure projects that sometimes are not as appetizing or easy to finance, to kind of help that flow of capital go to transition?
Well,
you cannot ask it back to him, okay?
Yeah, exactly. What is HSBC doing? No, look, just very, very quickly, because this is the sort of thing that could go on for about 2 hours on that topic. But we've started to see some regulation. The Bank of England move first in terms of getting banks to basically stress test their climate risk exposure. I think there's going to be a lot more of that coming in the future. We're definitely getting a lot more in terms of reporting, making TCFD mandatory, which is going to give a lot more transparency and a lot more data. And I think that sort of reporting push is going to get banks to start working out what's going on inside. And then at some point, I don't believe that regulators give us any free lunch, sorry. I don't think you're going to get green incentives. I think you're going to get brown penalties. And I think that's going to be what's going to move the needle, but we're probably still a couple of years from that.
And I think some people will welcome that approach. Anyway, I don't want to hold you more away from your coffee and your breakfast. So I just want to thank my panel. I think it was very interesting, and I hope you guys in the audience enjoyed it at least as much as I did. Please bring your hands together. Thank you, our panel.